Welcome to this short executive knowledge lecture on topic 3, paper 7 of the SFC licensing exams. This topic covers the equity market, and we'll be looking at the question right at the top: what is equity? Through fundamentals of equity securities, the stock market, the concepts behind the stock market, privatization of government-owned companies, and a fairly large section, section 5, the Hong Kong equity market. I will emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of the study notes that you see on the screen can be downloaded from the Executive Knowledge website under Paper 7 Resources. As ever, I strongly recommend that you supplement this learning with question practice, and we have over 300 questions posted on the Examinator.online platform. So if you go there, you will get plenty of question practice covering topic 3 of paper 7. So we start with the overview. What is equity? Now, you can get questions from any of these sections, so it's well worth sitting and appreciating what is being covered. We are told that equity is evidence of part ownership, that is shareholding in a business, providing a share in the profit or losses of the operations. There is no guaranteed return with equity, whereas with bonds, you get a regular coupon, no guaranteed return, and that's why we refer to equity as risk capital. Business returns depend on a number of factors: management effectiveness, customer demand, cost management, business systems, and the finance of the business. Now, all of that, you would say, well, that's common sense. But remember, it's that particular common sense that they could be setting a question on. 3 different types of equity financing: startup capital, expansion capital, and recapitalization. And they are exactly as they sound. So startup capital is for starting a new business. It's often friends and family or savings. Expansion capital will fund an existing business, not surprisingly, to expand, to grow. And recapitalization is where you're funding the restructuring of a company's capital and often involves replacing debt with equity. Now, there are a number of methods of raising equity finance: IPOs, initial public offering, going to the market, a rights issue, and we'll be dealing with this in more detail a little later, but that a rights issue is where existing shareholders can subscribe for more shares in proportion to their existing holding. Private placement goes to specific investors without a public offering, although it can be combined with a public offering. Dividend investment plan, that's where existing shareholders invest their dividends. So they don't take the cash dividends, they invest them in further shares of the company. Equity warrants are referred to as equity, and these are a form of option, give holders the right to purchase shares, specified price within a particular period of time. So you have the exercise period for a warrant, and you can then buy shares in that company. And equity warrants are also referred to as subscription warrants. Retained earnings is a source of finance. So instead of distributing all profit as dividends, you keep it in the business. And private equity, that's raised from high net worth individuals often. So we invest in a private equity fund, and that money is then invested often in immature, high growth companies. Private equity funds are on the lookout for a very healthy return from the growth of the company they invest in. And finally, venture capital, it's a form of private equity, but they are focusing on early stage businesses, not usually startups. That would be referred to as seed finance, but venture capital firms funding early stage businesses. Now, why would you want to invest in equity? You want to make a financial return. How do you make that financial return? Either dividends or capital gains, or ideally both. And that's why we invest. Moving along, section 2, fundamentals of equity securities, IPOs. Well, I've already touched on this. This is where we go to the market to raise funds, known as the primary market. And when you have an IPO, you must issue a prospectus with information about the offering. And that prospectus should include business description, investment highlights, strategy, industry analysis, risk related to business investment, and financial information analysis. And the idea is that you are as transparent as possible and giving potential investors as much information as you can. The last bullet point under section 2.1, IPOs do not always involve new shares being issued. It could be existing shares, and that would be in a situation where the original founders, owners of the business, take the company to market and they are selling their own shares. Nice way for owners to monetize their involvement in the company. Section 2.2, rights issues. Now, as I said a little earlier, this is where we issue shares to existing shareholders, and it's a prorated on the existing number of shares that are held by shareholders. Two types: non-renounceable rights issues and renounceable rights issues. The first one, renounceable rights issues, that's where you can renounce your right. You can sell it to someone else. But a non-renounceable right issue, you cannot sell it. You either take up the rights and buy the shares at the subscription price, or you don't, you lose the right. The rights issue subscription price will always be below the current market price. Otherwise, it's not going to work. There's no incentive to existing shareholders to buy more shares. And a very important concept, the theoretical price that rights can be sold for, it's a function of your entitlement and the subscription price. And we're going to look at an example. So Charlie holds 200 shares worth $2 each before a 1-for-4 rights issue is announced with a subscription price of $1 per share. What does this mean? Well, it means currently the market price is $2, and these extra shares are being issued at $1. So that's attractive. The existing shareholders will likely take up the rights. A 1-for-4 rights issue means for every 4 shares you currently hold, you are entitled to buy 1 more. A 2-for-5 rights issue, for every 5 shares you hold, you're entitled to buy another 2. Okay, let's look at the numbers. Value of shares before issue, 200 multiplied by $2, giving us $400. The rights issue entitlement, well, we divide the 200 shares that Charlie has by 4, and we get an extra 50 shares. How much are those 50 shares going to cost? $1 each, giving an extra $50. So the value of the total shares held, 450 Hong Kong dollars. How many shares did Charlie now hold? The original 200 plus the 50 in the rights issue, 250. So theoretical value of the shares after the rights issue, which is a classic exam question, 450 divided by 250, $1.80. Now, what are the theoretical value of the rights? Well, I am entitled to buy a share at $1, and that after the rights issue will become worth $1.80. So the value of the rights is the difference, 80 cents. With a bonus issue, it's similar to a rights issue. However, there's no subscription price. You get the shares for free. And looking at the example, top of page 4, Charlie holds 200 shares. They're worth $2 each. And then there's a 1-for-4 bonus issue. There is no value of rights because you don't have a right. You automatically will receive these shares. Number of shares before the issue is 200. The value before the issue, $400. Bonus entitlement, 50 shares. Number of shares after the bonus issue, 250. So the theoretical price of the share goes down from $2 to $1.60. You get that by taking the 400 divided by 250. So the net effect with the bonus issue is an increase in the number of shares held and a proportionate decrease in the share price. Be aware of that. That can be subject of a question. Now, we cover rights issues and bonus issues in bits and bytes on the Executive Knowledge website. That's a 6 or 7 minute explanation of how to address these types of questions, and I introduce a shortcut, and all of that's free. If you go to bits and bytes under paper 7 on the Executive Knowledge website, you'll be able to access it. Moving on to section 3, the stock market. Well, it's intermediary platform. This is not the stock exchange. This is the stock market, all buyers and sellers. And on the stock market, we have dealing costs, including brokerage commissions, stamp duty, levies that are payable to the regulators, for example, the SFC, and also fees that you will pay to the stock exchange if you're trading on the stock exchange. Now, stock market indices represent average price level of a stock market, and very useful tool for comparing market performance, historical levels, etc. Examples of stock market indices are given there: the Dow Jones Industrial Average, the FTSE, Financial Times Stock Exchange 100, Hang Seng Index, and the Nikkei 225 in Japan. And the MSCI is an international benchmark covering a number of markets and used by institutional investors. Now, the stock exchange is the actual infrastructure allow the trading of stocks, often around the world now. It's electronic. 2 types of listing: main board listing and a secondary board listing. In Hong Kong, the main board of the stock exchange is where you will publicly list companies with proven track records. The secondary board listing in Hong Kong is GEM. Originally, it stood for Growth Enterprise Market, but now we just use the mnemonic. Smaller companies that do not qualify for main board listing are attracted to the GEM, and we'll be looking at that in more detail in a moment. The advantages of being listed, a favorite exam question area. So the advantages: potential to increase the capital base, access to a liquid secondary market with instant pricing, increased corporate profile. You're now listed. People are talking about you. Your results are reported. And they tell us enhanced employee loyalty, because now you get share option schemes because these shares have value. You have an immediate pricing mechanism. Disadvantages of being listed: spread of ownership. So maybe the ownership was fairly tight before the listing, but then you've got to have at least 300 public retail market owners being introduced. So ownership spreads, that could be seen as a disadvantage. The onerous reporting requirements of the stock market and increased administrative costs are also considered disadvantages. Section 3.3, bull and bear markets. Remember, a bull market is one that is increasing in value. A bear market is one that is decreasing in value. And section 4 covers the privatization of government-owned companies. This is where a government owns a particular company and then decides to list it and take it out of government ownership. It was a big move in the 1980s in the UK and the US for privatizing government-owned companies. Why would a government do this? Well, we list the objectives: improving competitiveness and economic efficiency generally in the economy, reducing levels of public debt, increasing public revenue, so you can pay off public debt with the proceeds of the share issue, broadening share ownership outside of just the government, encouraging shareholder scrutiny of management. And privatization can benefit the economy as a whole by improving economic competition and efficiency, guiding idle private sector savings into productive investments, creating new finance sources for those companies, and moving government assets to the private sector where we're told they can be managed more efficiently. Obviously, there'll be some debate on some of these points in some circles, but as far as the exam is concerned at Paper 7, know those government objectives and know the benefits of privatisation to an economy. A couple of final points on privatisation. Privatising a government monopoly will often involve industry restructuring to make it work, can be lucrative assignments for professional firms. And two examples of Hong Kong government privatisations, listing of the MTR, and that was way back in October 2000, and the Link Real Estate Investment Trust in November 2005.